So my name is Jeffrey Wang, and I'm part of the multi-asset team at J.Pmogon Asset Management. We've been partners with Hanwha for close to 5 years now in the TDF product. And hopefully over the next few slides, you get to know us a little bit better. At J.Pmogon Asset Management, we've been managing multi-assets for over 50 years. We've launched 60 target date funds in the US, and we've started doing that from 2006 onwards. And we have a very senior experienced bench of PMs that manage our target date funds with an average investment experience of 27 years. The middle pie chart there is our book of business. So within multi-asset, we manage 245 billion, of which 93 billion is in target date funds. So that's close to 40% of our book of business. So whenever we think about how to improve our business, how to get better as an asset manager, of course, target date is something in the middle of our attention. And the pie chart on the right there is the whole of J.Pmogon Asset Management capability, about $2.5 trillion worth of management. So as a target date manager, it's very important that we have a big platform of strategies that we can choose from. And in a subsequent slide, you'll see that we have some of the industry's top performing strategies as well. So obviously creating a target date is a very complex process, but thankfully we've been doing it for close to 20 years. One of the key inputs that we have to put into a target date fund is country-specific investor experience and demographics and preferences. So obviously in the US, we have JP Morgan Chase Bank that we have a lot of data for that we can use for target date funds. For a country like Korea, we work very closely with Hanwha to look at industry, demographics, research, surveys, to try to have the right inputs going into target date. This is our track record of our target date funds in the US. One of the target date series and its performance relative to competitors since inception. And you can see the fact that we're sort of close to the top suggests that we have been delivering very good risk-adjusted returns for our targeted investors in the US. And one reason for that, as I mentioned earlier, is our platform is very, very strong. So we have some of the industry's leading mutual funds. And what this pie chart shows is how much of our mutual fund beats industry peers over the past 10 years. And you'll see across the board, it's 86%. But if you go into the asset class specifics, you see that the returns are still very strong. So we're strong consistently across the board, which is great for multi-asset because we have a lot of choices. Another reason why we've done so well is Ltcma, because the best portfolios need the backing of the best capital market assumptions. And that's why every year we take 50 of our senior investors, we spend 9,000 hours to put this together, which looks at the forward-looking return, volatility, and correlation of over 200 asset classes and in 16 currencies. So we're looking out at the next 10 to 15 years and finding what is the average number, what is the average expected number every year for those asset markets. And it's very important. It's not just academia. It's very practical because it powers 700 billions of assets, which is managed by JP Morgan Asset and Wealth Management. And this publication is used by a lot of our sophisticated and institutional investors to power their own long-term asset allocation. So, when we construct a portfolio, it's a little bit like constructing a football team. We're very close to the World Cup, so I'm going to use a football analogy. Understanding your client's objectives, risk, opportunity set, it's like understanding who your own players are, who you're playing against, and how many goals you need to score to win the game. But the middle part here, I think, is what really sets us apart. Because we've had 7 years of Ltcma, it's like we've had 27 years of coaching experience to know how well does our forward players attack, just like equities attack. How well does our defenders defend, just like fixed income defend. And how well does our forwards and defenders play together? The better we know them, the better we can set up the right formation, the right tactics. So do we play 4-4-2, or do we have all the defenders defend to try to win the game? we think we're very good at doing that. And the proof is in the numbers. So what this is showing is over the last decade or so, what did we predict the average 60-40 will deliver over the next 10 years? So on an annualized basis, what is it going to deliver? And what did the 60-40 deliver in real life? And we've not been outside a 80 basis point zone. So we've been very close to predicting the actual number that 60-40 divides. So 2022 has been a really tough year for most investors, right? Bonds are down, equities are down, the dollar is up. It's been very, very tough. Everything's in the red. And it's human nature to be so caught up in the present that you don't see the light at the end of the tunnel. Another football analogy is, the famous Korean player, Song Heung-min. If Song Heung-min had a very bad game in his first game in the World Cup against Uruguay, do you decide that he doesn't play again for the rest of the World Cup? That'd be pretty crazy because he's been the best player for Korea and he's had a very good track record, and one bad game doesn't make him a bad player. In the same light, the 60-40 had a really bad one game, 2022. So are you going to say it's the death of 60-40? I don't think that's the right answer. And the Ltcma does a really great job of helping us take a step back and seeing the bigger picture. So what is it saying? It's saying that the 60-40 is back. The 60-40 for the next 10 years will deliver the highest expected return on an annualized basis than it had for the previous decade. And one of the key reasons for that is that we don't think inflation will run away. Central banks have been so committed to zoning out inflation over the medium term that if you take the next 10-year forecast, we think the average inflation is only going to go up by about 30 basis points. So we're not in a higher inflation long-term sort of zone. And that's a great news for a 60-40. Alternatives have been great this year. And it's provided good returns and good resiliency. And we think that will continue to be the same. But what is even more attractive is the alpha, the protection against inflation, and the diversification that alternatives can provide. So in our models, if we add 10% private equity, 10% real estate to a 60-40, you'll boost your Sharpe ratio by 10%. So still a very good tool to have in your arsenal. Some quick numbers from the Ltcma for 2023. We talked about the 60-40. Last year's prediction was 4.3% annualized for the next 10 years. Now it's 7.2% annualized for the next 10 years, which essentially means that if you hold a 60-40, you'll double your money after 10 years. And this number here, we're just talking about beta. We're not even talking about alpha. What about US equities? 4.1% to 7.9%, essentially double what we predicted from last year. And fixed income, I think, is really staggering. US aggregate bonds, 4.6%. We're saying that our prediction this year, US ag bond is going to deliver more return than our prediction last year for US equity. That's a massive turnaround in dynamics. And basically, it's pretty much the same for all the other asset classes, going up between 200 and 300 basis points. So investors have a lot of choices now. And so we call our Ltcma for 2023 back to basics. And I'll explain what we mean by that. So if you look at the efficient frontier of stocks and bonds, we talked about the 60-40 has gone from 4.2% to 7.3%. This line has been coming down every single year for the last decade. And here it was in 2022. But suddenly it's jumped back to where it was about 10 years ago. So investors who have been leveraging their portfolios, reducing quality in their investments, or adding more risk to their portfolio for the last 10 years to maintain their level of return, they no longer have to do that. If they anchor their portfolio with a 60-40, we expect them to deliver 7.2% beta over 10 years. So they don't have to do a lot of funny stuff. They can go back to basics with simple traditional portfolios such as 60/40. And we think that is very important. This is the same efficient frontier for Korean investors in Korean won. So we talked about we do forecast in 15 plus currencies. The Korean won is one of them. Similar story. So the expected return has gone up, but it hasn't gone up as aggressively as the previous page, which is dollar investors. And the key reason for that is because of where the Korean won is now relative to the US dollar. So we expect the won to appreciate on average about 2.2% every year versus the dollar for the next 10 years. So for a Korean investor investing in global equities, you have some fixed income headwinds, you have some currency headwinds that you're going to have to contend, which reduces your return potential. So remember, all of this is looking at the long term, right? So we're not saying 7.2% is what 2023 is going to deliver you. We're saying it's the average expected return every year for the next 10 years. But as investors, especially advising Hanwha on target date funds, we can't just simply say, put your money away here and don't think about it for 10 years. We have to tactically manage. We have to look at the short term. We have to have shorter term market outlooks to tell us, should we be favoring equities or not favoring equities, etc. So that's why I'm going to pass my mic to Kerry, who's going to talk about what our shorter term outlooks are. Kerry.
Hello everyone, thank you for coming along today. The short term outlook is very similar to the long term outlook for a variety. And it's because this year was dominated by inflation, it was dominated by interest rates, and who wants to guess what's going to matter for next year? It's going to be inflation and interest rates and also recession. I'm going to talk about really three things and keep this brief so we have lots of time for questions. The growth outlook for next year is one of very sluggish growth and one where developed markets are going to be doing very well if they avoid a recession. Certainly in the case of Europe, we think about a recession in the coming quarters, the UK, a recession in the coming quarters, the US, very likely to go into recession. It's looking like it's heading that way. But regardless of whether you get a recession or not, you're going to have a period of very weak growth in these economies. And it may feel like a recession if you're a business owner or if you're a consumer, and the outlook is going to be one of that period of weakness in the growth because we have higher interest rates, which is trying to reduce that demand. These are our forecast numbers for the US, the Eurozone, emerging Asia, and Japan. The diamonds are what we thought the growth rates would be at the start of this year for 2022 and 2023, and the bars represent what we think the growth rates are going to be now. And you can clearly see for 2023, these bars aren't very tall. So for the full year, you're getting less than 1% growth from the US, you're getting even less from the Eurozone. It's a case of that very weak growth environment as we see the effects of those higher interest rates really impact on economies around the world in terms of driving down demand and driving down that inflation outlook. Which brings me to the next point, that inflation view. That's really where we're heading. How much of the inflation that we have felt this year will dissipate across the course of next year? The biggest question for markets and investors is just how sticky can inflation be, and will central banks get inflation back to target in time? It's really a race between those tighter financial conditions or the slow-moving nature of inflation, and who wins that in terms of creating a recession around the world. These are our forecast numbers for inflation rates, for the headline rate of inflation, again for the US, the Eurozone, emerging Asia, and Japan. In the case of the US, they track this very nice straight line down, which is definitely not going to happen. Nothing moves in a straight line in the financial world, but we are going to see the fact that we've had a peak in inflation in the US, and it will start to come down. Soon we'll reach a peak in inflation in Eurozone, and then it'll start to come down. And the same will be true for Korea and for many other markets around the world, that inflation will be much lower next year than it has been this year for really three reasons. The first is energy prices. We know that the price of oil increased massively over the course of this year, but when we look at those year-on-year price changes next year, they're obviously going to be either the same or lower, so it becomes disinflationary. That's quite good news for consumers if you're thinking about the impact on petrol prices. The second big thing is thinking about core goods within the inflation basket, those things that we buy more frequently during the pandemic, such as furniture or electronics, things that we don't buy anymore because we've already done so. Those are also starting to come down in terms of that year-on-year price comparison because we have less demand for them and because supply is better, because those supply chain issues around the world are now starting to resolve themselves. And we can look at the metrics from business surveys or simply the number of ships that are traveling or sitting off ports or the semiconductor supply chains to indicate that that is actually starting to come through, and you are seeing that rectification in the supply side. The third point is the toughest point. These are the things that create the stickiness in inflation. It's the tight labor market or the low unemployment rate in the US and elsewhere around the world where unemployment rates are at decade lows. That's creating wage inflation and that pressure in the economy as we spend more, and we have to spend more because our wages are going up and the prices are going up. And the second thing, particularly within the US, is the shelter costs, the rent costs, the house prices, which have been moving upwards and creating a very slow-moving trend in the inflation outlook. So it's really not energy or not goods that are going to be the concern when it comes to inflation and whether we do get these straight lines. It's going to be how much the labour market starts to ease back and unemployment rates rise, and how much those shelter costs and rent costs start to come down to really alleviate that pressure. Because we don't have clear answers to these questions, we do think that's going to happen, but we're not sure exactly on the pace that it will happen with. We have to be a little bit conservative when we understand that these are big risks that overhang both the economic and market outlook for next year. When it comes to what is in the price, though, a lot has been put in the price in terms of those interest rate hikes that have come through over the course of this year and what will be in for next year. We look at the policy rates from developed market central banks here. You can see they're just vertical, right? These things have gone up at the fastest pace since the 1980s. It's been very aggressive interest rate hiking cycle compared to these nice stepped prior ones. But that has been the disruption of this year. At the start of the year, the market thought interest rates were going to be around about 1%. And clearly now we're thinking about numbers that start at 4 in the US or over 3 in many other places. A lot of that repricing has happened. And if we look at the grey line, this indicates the market pricing for the Fed funds rate in the US. It's already close to 5%, which is in line with our thinking on where that rate will actually get to. The Fed will either add another 50 basis points in December, probably add another 25 basis points in February, and maybe they do one more, or maybe at that point they just wait. The key point is that the market has repriced a lot of those interest rate hikes, that central banks are closer to the end of those cycles than the start, and they will wait and see what happens to the labour market, to inflation rates, while they understand that monetary policy acts with a lag on the economy. They won't cut rates, though, while inflation is still well above their targets, but they will pause for an extended period of time while they wait to see the effects play through to the market. The risk is that inflation doesn't come down fast enough, that the labour market stays tight, that this has to go up and the market hasn't priced it, and we end up with another period of volatility that we experienced at times during this year. What does this mean for investors? Well, it means we need to think about more defense and quality bias in our portfolios. We need to think about income from bonds and diversification from bonds for the first time in a long time, because yields have gone up so aggressively. We're now at a point where it's more likely those yields fall than rise significantly. And that's something that's been missing for some time in terms of that ability to offer a real income when those inflation rates come down and diversify against those risks and equities, which they haven't done this year. And in the equity market, it's all about what's been in the price already. So when we look at the relationship between the equity market and the corporate earnings outlook, typically the equity market will price in a lot of the bad news that's coming around either corporate earnings or the economy before we actually get there. And this is what these two lines represent. It's the price return for the MSCI World and also the earnings growth for the MSCI World. And you can see the green line, which is the equity market, has already fallen significantly ahead of the earnings outlook. It's pricing in those downgrades in earnings. It's pricing in some chance of a recession. However, it's probably not pricing in a deep recession. It's not pricing in the fact that we are only just entering in the earnings downgrade cycle. It's not quite pricing in the fact that we don't know if inflation's going to go away and that interest rates won't go higher than over 5%. And so we still have that quite cautious attitude towards equities. We think there's much more attractive valuations on equity markets around the world. And when we do like equities, we do like the defensive bias that comes with owning quality assets, such as ones that offer high cash flow and that can perform well in a low growth environment. But we aren't at a point where we think we may have seen the trough in equity markets, particularly in the US, and we really want to see more clarity on central bank policy, on inflation, to really adjust and say we've seen the trough in the market to come back up. And that may take a couple more quarters before we get to that point. But after that, we may be in a period where the market has priced in that recession in the correct way, where the market can start to turn, and it does start to turn during a recession, not before it, because it sees the upside, the light at the end of the tunnel, and it starts to reflect that. But I would just have a degree of caution about saying, get back into equities in an aggressive manner when things may not quite be in the price fully, and we still have those, not black swans, but those white swans of well-known risks that we can see on the horizon that we have to be very mindful for. I'll leave it there. Just a couple of thoughts to finish up. We are seeing those tighter financial conditions, that fading fiscal support that we had during the pandemic come away, consumer demand getting softer. Inflation will come down over the course of this year because of energy, because of core goods. There will be some stickiness around shelter and around wages, and that's why the labour market is so important. But central banks aren't going to cut rates in that environment. At best, they're going to pause and wait to see if inflation does follow that trend downwards. And so it is a race between those tighter financial conditions and thinking about the inflation outlook. So we very much think the focus for assets is still in quality, whether it's in government bonds or whether it's in investment grade credit, and also the quality bias in certain parts of the equity market as well. But I will finish there, and thank you very much for your time.